Hey everyone, Mortgage Nerd here. So I want to talk to you a little bit about the lending standards. What do I mean by that? Well, when the market crashed in 2008, the previous almost decade, we had very lax lending standards, meaning a lot of people with bad credit and bad programs, not just the credit, got into mortgages. I showed a chart a few weeks ago where there were many more, exponentially more people with credit under 620 that got mortgages back in the 00 decade leading up to 2008. When now we have exponentially lower, a fraction lower of people that have a credit of 620 or below. So let's look a little bit more at some other charts. Here you can see the product risk. These were risky products in the dark orange. I think that's orange. Remember, I'm colorblind. Then the lighter orange here is borrower risk. So that the credit score stuff. So we had a ton of risky products like pick-a-payment loans and adjustable rates that adjusted whenever they wanted to, not when the markets changed. Those are all illegal. So if you can see, they're pretty much gone. Even right now, people are like, oh, we have these risky bank statement loans. No, those aren't risky because you're showing that people have income to pay their loans. Now there's borrower risk. There's always going to be borrower risk. There's always people with lower credit scores, but there's far less than there used to be. So let's look at our foreclosure activity, because to me this is not everything, but it's a huge part of why we went into a crash in 2008. So remember, 2005, 2006, the market was really heating up. You could say the way the values have gone up now is kind of like 2020, 2021 would be these years, maybe 2023 would be where, we could enter some kind of a crash based on values going up. But look at how many foreclosures there were, and they were rising at the time. There were people going into foreclosure because of all the other stuff we said, their credit, their programs, so many factors, so many reasons. But look now, this is just, it's nowhere close. You've got to multiply it almost by 9 to get to this level here that we had in 2006 of the level of foreclosures. And we're nowhere close to it because they're going down, and there's so much equity in people's homes, and they're in good products and good credit scores that they're very likely not going to go into foreclosure. They might sell instead of going into foreclosure. And there's a ton of buyers to buy it up. This is the chart I was talking about that I posted recently. It was a little bit different though. Look at the credit scores under 620. 2003, 2004, 2005, 2006, 2007. 2007 was the beginning of banks going under because of all these issues. I remember New Century was the first one. I think it was early 2007. And I remember hearing about it. We were using them a lot. I was like, wow, what's going on? We're nowhere close to that. It's nothing like what we had back then. So that's it. This is where our lending standards are, and it shows you foreclosure data as well. Where are we headed? Very likely not where many people think, which is to a market crash. Mortgage Nerd out.